a high probability, if you are holding equity shares, that you are going to start getting or have already received dividends in the form of final dividends. A lot of companies are giving them out. ITC, for example, it traded X dividend just a short while back, and you will have received, or you will soon receive, those dividends in your bank accounts. How do you account for that when you're paying your tax? Because remember, dividends that you receive from these companies are taxed at the slab rate in your hands. There used to be a time when they used to be deducted at source. There used to be a dividend distribution tax. That no longer applies, and you have to pay a slab rate for everything that you receive in this form. When you account for it, do you pay advance tax on it? All of that is covered in this report by my colleague Mahima.
Right, so there are two ways in which you can locate all your dividend in one place. The first way is to look up your AI statement, and the second way is brokers like Zerodha, Angel One, etc. have a feature to track your dividends separately. Now, the question arises as to how your dividends are taxed. As per the Finance Bill, Finance Act 2020, the taxability for dividends shifted from company which is paying the dividend to the individuals who are getting or receiving this dividend. Generally, a normal TDS of 10% on dividend income is paid in excess of 10,000 rupees. So, for instance, if Mr. X has received a dividend of 16,000 rupees from an Indian company, since he has received the dividend that is exceeding 10,000 rupees, a TDS of 10% will be deducted on the dividend income, that is around 1,600 rupees. Now, in terms of the overall money, the 1600 will be added to the total income of Mr. X and will be taxed at his particular slab rate. So, for example, if Mr. X slab rate is 30%, then dividend tax will be paid at 30% plus cess. Now, in terms of non-resident person, TDS is required to be deducted at the rate of 20%, and this is subject to the DTAA with respect to which country India has DTAA with. Now, in terms of people who have income which is below exemption limit, they can file form 15G or 15H in order to not pay taxes or not deduct any kind of dividend, any kind of TDS in this dividend income. Lastly, in terms of advance tax on dividend income, advance tax is applicable overall if your tax liability exceeds that 10,000. So, yes, the advance tax is required to be paid on dividend income as well. Lastly, important considerations, dividends are generally credited to your demat account after 45 days of the record date. So, this is the overall view as to how taxation takes place for dividend.